Joins us. Aaron, good morning. Thank you so much for joining in. Can you start off by telling us what a super fund is and how you look at generating the kind of returns that you already have?
Thank you. Good morning. Superfund is a diversified managed futures fund. It's trading about 50% in financial futures like stock indexes, interest rates, and currency pairs, and about 50% in commodities like energies, metals, soft commodities, and agricultural products. So it's very diversified. And the reason that managed futures funds historically have outperformed equity markets is simply that we're able to take advantage of the global trends. So if there's an upward trend in the market, we could take long positions in futures. If there's a downtrend in the market, we could also profit from that by taking short positions in futures, and all the while maintaining a very diversified portfolio. So that's the main reason why we've had a positive return so far in 2008.
What is the current call on equities and commodities? Which of these asset classes are you long on and which are you short on?
We continue to have short positions in some global equity indices, although I would disclaim the fact that we have no positions in Sensex or Nifty at the moment. We do have short positions in global equities. We've reduced these positions over the past few months because of the high volatility. We've also benefited in the past few months from short positions in energies and particularly in oil and natural gas. We've also had short positions in base metals like copper and lead and aluminum. So those have been some of the positions that have yielded positive results.
Right. Aaron, I'll be very, very curious to know what your current portfolio mix is looking like in this fund, because you've pretty much outperformed every falling market in the past couple of months, if not years. So tell us, how have you allocated your funds right now?
Well, there's two things behind the allocation strategy. First of all, it's very diversified. So we're not depending on any one market. Second of all, it's based on a systematic trading strategy. So Superfund actually has a quantitative systematic trading program which is identifying the trends in the market. By having a systematic approach, we don't have our emotions driving our investment decisions. So I think, if you look at the equity markets in India today, for example, it's certainly fear which is the driving factor in the market prices. Normally when you see bull markets, it's sort of greed or overconfidence that traders have in the market. By having a systematic approach, we take the emotions out of the trading process. So that enables us to not be afraid in a year like 2008 and not be overconfident, for example, in a bull market.
Okay. Sans emotions, without any emotions, how have you played the Indian markets, and what is the strategy going to be going forward? I mean, if you can just give us some kind of context over the last couple of months, because the markets are up about 23-24% off the lows on the 27th of October. Did you cash out? Did you go short aggressively on these markets? How have you played the Sensex?
Going forward, at the moment, we have no position in Nifty or Sensex. I would want to point that out. We expect going forward that it's going to be a choppy sort of range-bound market. If you look at the volatility of Sensex since 1980, it's around 30%. So we expect that there's going to be a trading range plus or minus 30% from where we are here over the next couple years. We like India as a country as compared to, the Western countries like the U.S., which are heavily debted. We think that the Western economies are going to be suffering for many years, and this is going to have a negative impact on equity markets worldwide. Unfortunately, the Indian markets have a high correlation to global markets. So this is not a positive indicator for Indian stocks. There could be a short-term rally. Especially with a 30% volatility, it wouldn't be too surprising to see Sensex or Nifty bounce even further upwards from these levels. But we are very cautious about equities going forward. We prefer to have exposure to real assets like commodities, real estate, especially gold, or a diversified managed futures fund like Superfund.
Right. Aaron, talking about commodities, we've seen a rally out there. Are you long on it, or would you start shorting it after this kind of an up move, especially metals?
It really depends. In the metals, we still have short positions in the base metals. If there's a huge reversal, we'll simply close those positions that are short. In the precious metals like gold, we're not short. We have a very bullish long-term outlook on gold. We've actually said that over the next 2 to 3 years, we expect gold to go to $1,500 per ounce. Certainly in the long run, because we think that inflation will come back as a factor in the next few years, gold can go even higher, as much as 2,000 plus per ounce. But that's why at Superfund we launched Superfund Gold, which is actually a diversified managed futures fund, which is priced in ounces of gold. So you'll note that the rupee has been quite weak lately compared to the dollar, as most major currencies have been. So we expect that gold actually is the best currency to own in your portfolio. We look at gold as a currency, not as a commodity or jewelry, but look at gold simply as what it's been for the past 2,000-3,000 years, which is the main form of currency. So what we've done at Superfund is launch Superfund Gold, where it's a diversified futures fund based on the gold price as well.